Hi guys. So now I'm going to talk about chapter 9, the master budget. I think you have done some of the homework and are currently working on a project. And the project is about master budget. And I hope that this video will help you understand the topic in this chapter as well as help you work on the project. So um, the master budget. So the budget is very important in the business world. And so basically, we know that managerial accountants, the responsibilities include planning, directing, and controlling. And then the budgets will play a role in each of these activities or responsibilities. Um, Usually, a firm will have budgeting for their long-term goals, and then it may extend like 5 to 10 years into the future, and then to let people or like shareholders know what they are expecting from that firm. And the budget periods usually prepare for an annual period, but sometimes it will be further broken down into quarters or months. And sometimes there's gonna be a rolling budget where you know everything keeps updating in a 12-month period. Um, Also, the budget process is an ongoing process, and the budget is going to be reviewed and revised during the year if it's needed. Like anything unexpected happened, and then people the change the budget. There are two kinds of budgeting structure. The first one is a top down, and then the top management will determine everything, the budget for each of the department. It's not very widely used by a lot of companies, and then it is detrimental to motivation. And the second kind is a participative. Um, it includes participation at many levels of management. It has benefits because the lower level managers have better information about their needs and then what they're gonna get, and it enhances motivation. But there are also some disadvantages. Actually, there are a lot of research about this because since the lower management determines the budget, sometimes they will overestimating expenses and underestimating revenues just to, just lower their stress and then like improve, make their performance better. Um, There will be a budget committee that reviews and approves the final budget in the firm. And then for starting point, there are two kinds of budgeting, but usually the budget is based on the past experience, what happened last year, and then this year's budgeting is based on the experience from the past year. For example, like utilities, um, cost of production costs, things like that, and then they have the experience what we need in the past, and then what do we need in the future, just to have an idea. And also, there's a zero-based budgeting is not very um, usually used in the manufacturing firms. It begins with the budget of zero and then justify every dollar. It is time confusing, consuming, and labor intensive. And usually it's used for certain sensitive or high dollar line items. Um, Benefits of budgeting is very apparent. It forces managers to plan and also promotes communication and coordination, and also it provides a benchmark for performance measurement. Um, so master budget, there are two kinds of master budgets. One is the operating budget, and the other one is the financial budget. Operating budgets deals with our budgets for our day-to-day business, and it starts with our expected sales or revenue budget, and then based on our sales, we'll adjust our production budget, like how many products do we need to produce, and then also our raw material budgets and our labor budgets, manufacturing overhead budgets, like that. And then for operating budgets, it will end with a budgeted income statement. So we know and we remember that the income statement starts with sales, and then we will deduct cost of goods sold from the sales, and then after cost of goods sold, we have our operating expenses, and then for the budgeting, we're gonna do a budgeted income statement for maybe the next quarter, and what is our expected sales, what is our expected cost of goods sold, and what are our expected operating expenses, and what is our expected net income, just to have an idea and just to have a benchmark for management performance. Okay, and also financial budget. Financial budgets include a project's collection and payment of cash. So what we care about is we don't want to be short of cash. So we want to know like how much cash we are expected to collect from our customers, and how much cash do we need to pay for our bills and things like that, and our taxes or interest. And then we want to have sufficient cash for that. So we need a budget for our cash flows. And also some firms may also want to do a forecasted budgeted balance sheet. We're gonna talk about that in detail in a later slides. So this is master budget. Like I just mentioned, basically this part includes what we are doing in managerial accounting. First, we're gonna have a sales budget, and then based on our sales budget, we know our we have our production budget, where we know like how many products do we need to produce in order to meet our sales needs. And then once we know our production budget, we have to figure out our production costs, and we know the production costs has three components: direct material, direct labor, and the manufacturing overhead. And we're gonna figure out the cost for each of those, and then we're gonna know the operating expenses budget, and then come up with our end up with our budgeted income statement, and we know like how much income we are expected to have for the next period. And then once we have our budgeted income statement, we probably have our cash budget, capital expenditure budgets, and the budgeted balance sheet. And these parts is our financial budget. If you are in accounting 202 section 005, the project is about operating budget. But if you are in the honors section, you can see that additional requirement for financial budget. Okay, so operating budget, it starts with the sales budget, and then sales budget is the basis for every other budget actually, and then it's prepared by sales and marketing managers, and usually we'll do a like expecting number of units to be sold and times selling price per unit, and then the sales will include both cash and credit sales. This is a very straightforward and easy example, just to have an idea how we do our sales budget. So this company expects cash sales for July is 15,000, and a 26% monthly increase during August and September. Credit sales of 12,000 in July should be followed by 30% increase during August and September. What are budgeted cash sales and budgeted credit sales for September, respectively? So we know that July is sale for July is 15,000. And then there's a 26% monthly increase during August and September. So there's gonna be, we're gonna times 1 plus 26%. And this is our August sales. And then we're gonna times, again, 1 plus 26%. And now we reach our September sales, and that number is 23,814. Okay, and you use the same way just to replace the sales by credit sales and use the same formula, same approach, and you can get the expected budgeted credit sales for September is 20,280. So the answer is D. Okay, production budget. We know our budgeted sales, and then we have to know, how many products we're gonna produce in order to meet our sales requirement. So again, production budget starts with sales budget, and production budgets is in units only. We simply want to know how many units do we need to produce. So this is production budget. And then we want to also have a safety stock in inventory. Okay, so basically when we consider production budget, we need to know, like, first, how many units do we need to sell, and then we also want to know how many of like safety inventory do we need at the end of period. Okay, so what if, why do we need a safety stock? Is what if, our sales is significantly more than we expected, and then what if we're short of stock for sales? That's a really bad thing for the company, for the firm. Therefore, we're gonna have a safety stock just in case, just to meet the needs for significantly increase in sales. So that gives us to this basic format. This is the units needed for sales, and then we also know that our desired ending inventory, and then this is the total units that we need for this period. Okay, total units needed for this period is the need for sales and the need for our ending inventory. And then we usually will have some inventory at the beginning of the period, and then that counts like part of our units needed. So we're gonna deduct a unit in beginning inventory, and that comes to our units to produce. This is an example. This company desires a December 31st ending inventory of 900 units. Budgeted sales for December are 2,650 units. The November 30th inventory was 850 units. What are the budgeted purchases in sales? And if you use the above format, you know that what is our total units needed. Our total units needed is gonna be our sales need. Okay, this is very important. We wanna have at least 2,650 units for sales, and then we also want a 900 units for our ending inventory. This is our safety inventory, and that is 3,550. And then our beginning inventory is 850. Okay, and then what is budgeted purchases? that should be 3,550 minus 850, and that is 2,700. Okay, so the answer is C. This is another example. Actually, it's very similar to real life. Usually in real life, we don't do the simple things just for 1 month, but sometimes we have like a quarter in front of us to figure out. And this is actually the same thing for our project. I'm going to go over this. Let me see. Go over this example for you just to have an idea, maybe to help you understand how to like a starting point for your project. Okay, so these are some information. Sales projections in units for the next 5 months or as follows. So these are sales, budgeted sales, and that is starting point for our budgeting. Okay. Inventory at the start of the year was 350. So this is our beginning inventory of January, and desired inventory at the end of each month is 10% of the next month's sales. Okay. So if we look at this table, we can put these numbers here. So first, unit sales for January, February, and then March, we can just copy these numbers over here. So unit sales for January, 3,500, and for February is 3,400, and for March is 3,600, and the total for the quarter is 10,500. Okay. And the desired end inventory is 10% of next month unit sales. So for January, the desired ending inventory is going to be 10% of February sales. So that's going to be 340. And then February's ending inventory is going to be 10% of March sale. So it's going to be 360. And then the ending inventory for March is going to be 10% of the April sale, and that is 400. Okay. What is, so now it's gonna be tricky. What is the ending inventory for the quarter? Do we add all these things up? Probably not, because this is just a ending inventory. It's not like a total. It's just a time point. So the ending inventory for the quarter is gonna be the same as the ending inventory for the last month of the quarter. So that is going to be 400. Just think a little while about this, okay? The ending inventory for the quarter is going to be the same as the ending inventory for the last month of this quarter, okay? And then total needed, we just add all these things up, okay? Let me see. And then this is, I'll just give the numbers, 3,840. 3,760 and 4,000. Okay. And then total needed for the quarter, we now are gonna add this thing up. Okay. Beginning inventory. Beginning inventory for January is the beginning inventory of the year, which is 350. And what is the beginning inventory for February? Okay, so the beginning inventory for February should be the ending inventory for January, right? So just it's passed down from 1 month to another. So the beginning inventory for February is going to be 340, and the beginning inventory for March is going to be the ending inventory for February, which is 360. Okay, and now question here is, what is the beginning inventory for the quarter? is the beginning inventory of the quarter. When is the beginning of the quarter? The beginning of the quarter is the beginning of the year, right? And the beginning of the quarter, the beginning inventory of the quarter is going to be the beginning inventory of the year, which is 340. Okay. And then if we minus this from our total needed, we're going to come up with our units to produce for different month. So for this is 300 and 3,490, 3,420, 3,640, and 10,550. Okay. So this is how we do the production budget, and then we are required to do a production the budget of our direct material and direct labor and manufacturing overhead. So this table is, and this example is about direct material budget, okay? And it's based on the information of production budget from the table above. Okay, so let's look at this. I'm going to work on this with you. Okay, so units to be produced for these 3 quarters, actually, or over here. We just figured out on the top table. Okay, so okay, and then quantity of DM needed per unit. What is the quantity of direct material needed for each unit? It's very good because we have a per unit, and then we can know, like we can multiply and do things like that. So each planter requires 2 pounds of plastic. Okay, so it requires 2 pounds of plastic for each product. So that means for each of that is 2. And then what is the total quantity of plastic for the production of each month? So we're gonna do a times 2. Okay. Times 2. And then that gives us 6,980, 6,400, 840, 7,280. Okay. Oh, and the quarter 10,550, and also times 2, and then this is 21,100. Okay. And also we have a desired end inventory of direct material is the 20% of the amount needed for next month production. Okay, so next month's production for what is the ending inventory for January is gonna be 20% of the amount needed for February. So if you do that, is 1,368. Excuse me. And then for February, the ending inventory for February is going to be 20% of the amount that needed for March, which is 1,456. Okay, so now what is the desired ending inventory for March? It's gonna be the 20% of the material that needed for April. Okay, so how do we figure this out? So this is the most challenging here. And then in order to do that, we need to complete the whole table over here in order to figure it out. Okay. Okay, so let's do that. Let's do that. We're gonna do the same as we did for here to figure out April's information. What is April's unit to sell? It's 4,000. Okay, so it's 4,000, and then what is desired end inventory for April? Oh, again, desired ending inventory for April is 10% of next month's unit sales. And what is the 10% of next month's unit sale? That is 10% of May's sale. So that is 420. So we do a plus, then that is our total units needed in April. Okay. And then what is the beginning inventory for April? The beginning inventory for April is the ending inventory for March, which is 400. And then units to produce in April is going to be 4,020. And then direct material needed for April will be times 2, then that is 8,040. Okay. All right, so this is our direct material for needed for April, and then we do a 20% of that is going to be our desired ending inventory for March, which is 1,608. Okay, so again, in order to figure out this sale, March ending inventory, you have to need the information from April and May, and do the same thing as we did for this table for April and figure it out. And what is the desired end inventory of direct material for the quarter? Again, it's the same as that of the end of March. So it's 1,608. Okay, so total quantity needed. It's going to be the total quantity needed for production plus the desired ending inventory. Okay. And that is, so we plus this, that is, I just write down these numbers. This is 8,290, 90, 8,888, 22,708. Okay. And what is the beginning inventory of direct material? What is the direct material beginning inventory? It says inventory at December 31st reflected the company's desired ending inventory policy. And then that should be, what do you think? Yeah, it's going to be 20% of the quantity that you used for January, right? Yeah, so it's 20% of the direct material needed for January's production. So that is 1,396. So that's 20% of January's inventory. And then beginning inventory of DM for February is going to be the ending inventory for January. So it's and then for March is the beginning inventory for February. So 1,456. Okay. And then beginning inventory of the quarter is going to be the beginning inventory for the first month, which is January. And quantities to purchase is the total quantity needed minus the beginning inventory. And then this is 6,952. And this is 6,928. And this is 7,432. And this is 21,312. Okay. This is the quantity that we need to purchase in order to meet our production and sales expectations. And the cost for all these material is over here, 25 cents per pound. So we're going to do a times 0.25 of all these tables. And now we know that the dollar amount we need to spend on this direct material is 1,738 for January and 1,732 for February and 1,858 for March, and for the quarter is 5,328. So we need to budget this amount of money to purchase our direct material to meet our inventory need and our production need and our sales need for our first quarter. Okay, so the most challenging cell is here. If you are doing the project, you may go back and look over and see how I figured out the direct material needed for production for April, and then figured it, and then get this number over here. Okay. This is direct material budget we just did, and direct labor budget is more like straightforward. You will understand that in the project. And also our manufacturing overhead budget basically is based on so we have two portions, variable and fixed. And it's more like straightforward because you can do like a production predicted number of sales project. So this is sales and production projected to be 40,000 units, and then you just use the 40,000 units to figure all these out. I don't think there's anything challenging that need to go over, so just skip that to save our time, and then see what else I need to cover in the next section. Okay, so operating expense budget will period costs and both fixed and variable, and also include non-cash items. I think you should be good here. As far as for the projects, and to understand all these topics is similar to manufacturing overhead prediction is the same way as we did in the other projects, simply different. The simple difference is that this one is based on a projected number of units to be sold, but our prior projects is what is really happening. Okay, so after that, we're gonna have our budgeted income statement. Since we have our sales, projected sales from our sales budget, and then cost of goods sold. Cost of goods sold is here. Cost of goods sold is projected from our number of units to be sold, and times our manufacturing cost per unit, and that way we get our cost of goods sold, and you can plug in that here. And then operating expenses is from operating expense budget that you can figure it out. Okay. Okay, so next thing and the last thing I'm going to talk about is financial budget. They're like capital expenditure budget and cash budgets, and I'm going to focus on this example for cash budget, and I think it will be helpful for the honors section students to complete the financial budget on your project. So cash budget, usually a firm will have both cash sales and credit sales. And then they are gonna have some like cash collection experiences and policies. So this is an example of Brandon Wholesales. This firm has 20% of its sales in the month are cash sales, and the remainder are on credit. And this is the pattern that the credit sales, among the credit sales, 30% will be collected in the month of sales, and 50% will be collected in the month after the sale, and 20% will be collected 2 months after the sale. And sales in November last year were 100,000, and December sales were 120,000. And then first we need to figure out our cash sales and the credit sale for each month, and then we know we can know our cash collection for each of the month. So for January, our sales is 160, and we know that cash sale is 20%. So therefore, our cash sales is 32%, and credit is 180,000. And again, we do the same thing, or 20% for February sale is 25, and this is 100. And cash sales for March is 36,000, and credit sales 144,000. And then we're gonna need this credit sales information a lot, but first we need to put in our cash sales in this table. So our cash sales for January is 32%, which is just over here. And then for February, 25, and for March is 36, and for the quarter is we don't do all these sales, we just do the end of that. And then collections on credit sales, 30% month of sale. So 30% of the credit here is gonna be, so 30% of the credit sales in January. So that is 38,400. And then 50% a month after. So we can see that in January, we're gonna collect 50% of the credit sales in December. And then December sale is 120. It's not all, but 140, 120, only 80% of that were credit sales. And then again, 80% of that is credit sales, but 50% of that will be collected in January. So that number is 48,000. And then 20% 2 months after, that's the cash collection for November sales. November sales was 100,000, and 80% of that is credit sales. It's 80,000 credit sales, and 20% will be collected in January. So that's 16,000. So this is 16,000, and then total cash collection is 134,400. Then you're gonna do the same thing for February and March. I'm not gonna. Give me one second. I'm not gonna do that one by one, but I'll give you the number, and then for the quarter, you just add all these up, and then you can get your quarter cash collection, which is 427,400. So this is the financial budget for cash collections. I think this is the pretty much what I wanna cover to highlight in this chapter, just to help you with the projects as well. If you have any further questions with the homework or project or anything, shoot me an email or come to my office hour. And you can also always reach out to our Niedermeyer Scholar for help. that's it. And good luck with your project and your exams this is coming.